Hello everyone, I'm Asian Guy. Over the last few years, something unusual has been happening beneath the surface of global markets. Trade volumes are still moving, ships are still crossing oceans, multinational earnings still appear in quarterly reports. But the structure underneath those flows has begun to quietly change. Not all at once, not with a single shock, but in a slow, deliberate way that only becomes visible when you step back and look at the system as a whole. There's urgency here, but not panic. Because this shift isn't about a single commodity, a single country, or a single crisis. It's about how power, leverage, and stability are redistributed when global trade stops behaving like one integrated machine and starts breaking into fragments. And what makes this moment different is that institutions appear to be adapting before the public narrative has caught up. Capital allocation is changing. Supply chains are being redesigned. Strategic assumptions that held for decades are being quietly rewritten. This matters far beyond trade itself, because trade is the bloodstream of modern finance. When it changes shape, everything else eventually follows. Before we go further, subscribe right now, because what you're about to hear explains a shift most investors still haven't noticed. Let me walk you through the evidence slowly, because this story doesn't reveal itself through headlines, it reveals itself through patterns. For most of the post-Cold War period, global trade followed a simple logic. Production went where labor was cheapest, capital went where returns were highest. Goods flowed through predictable corridors. Risk was managed through scale, diversification, and efficiency. That model produced growth, disinflation, and rising interdependence. But it also created fragility, and over time, that fragility has been exposed. Look closely at global trade growth relative to global GDP. For decades, trade grew faster than output. That was the signature of globalization. Since the early 2010s, that relationship flattened, not collapsed, flattened. Trade stopped accelerating relative to growth. That was the first quiet signal. Then came supply chain shocks, geopolitical frictions, and policy responses that treated trade not as an efficiency mechanism, but as a security variable. What matters is not that trade volumes dipped during crises. What matters is that the recovery patterns changed. Now notice what quietly changed in participation quality. Multinationals began prioritizing resilience over marginal cost savings. Governments introduced incentives for domestic production, strategic stockpiles, and regional alliances. Foreign direct investment shifted away from purely cost-driven destinations toward politically aligned jurisdictions. These moves didn't show up as a single break. They showed up as a slow reallocation of capital. Shipping data tells part of this story. Freight rates spiked during disruptions, then normalized. But route utilization changed. Some corridors became less central. Others gained strategic importance. Regional trade agreements gained traction while global ones stalled. This isn't deglobalization in the dramatic sense. It's fragmentation, a system breaking into semi-autonomous zones. But this is where it becomes important. Fragmentation changes the economics of everything downstream. When supply chains are optimized for efficiency, inflation stays low and predictable. When they are optimized for security and redundancy, costs rise and volatility increases. That volatility doesn't always show up in consumer prices immediately. Sometimes it shows up in fiscal balances, sometimes in currency pressure, sometimes in lower trend growth. Let me walk you through the numbers that institutions are watching. Input costs across manufacturing have become more dispersed by region. The same component costs different amounts depending on where it's sourced, not just because of labor or materials, but because of compliance, tariffs, and political risk premiums. Firms absorb some of that, governments subsidize some of it, consumers eventually feel the rest. Over time, this erodes the disinflationary tailwind that global trade once provided. Look closely at capital flows. Reserve managers have begun diversifying away from a single dominant currency structure. Not because of ideology, but because trade settlement itself is becoming more regional. When trade fragments, invoicing fragments. When invoicing fragments, reserve composition follows. This doesn't require a collapse in confidence. It only requires a marginal change in incentives, repeated over years. We've seen this before, but only during stress periods. In the interwar years, trade blocs formed around political alliances. In the 1970s, energy trade reshaped currency dynamics. Each time, the financial system adapted slowly, then suddenly. The sudden part is what people remember. The slow part is where positioning happens. Now notice how industrial demand is evolving. Energy transition policies, defense spending, and technological sovereignty initiatives are reshaping what countries import and export. Supply chains for semiconductors, batteries, and critical infrastructure are being localized or regionalized. These sectors are capital intensive, slow to scale, and politically sensitive. That creates supply-side rigidity. When demand shifts, supply doesn't respond smoothly, prices become signals of scarcity rather than efficiency. This pattern doesn't appear often. For decades, excess capacity and global competition kept margins thin and prices disciplined. Fragmentation reverses that logic. It introduces bottlenecks by design. Redundancy replaces optimization. That may reduce tail risk in one dimension, but it increases baseline costs across the system. Let's talk about incentives. Policymakers are no longer maximizing global output. They are maximizing domestic resilience. Firms are no longer minimizing costs. They are minimizing disruption risk. Investors are no longer pricing assets solely on growth differentials. They are pricing policy stability, legal predictability, and geopolitical alignment. None of this requires a crisis to be rational. It only requires uncertainty to persist. Now, look at currencies through this lens. When trade was deeply integrated, currency volatility was dampened by global capital recycling. Surpluses flowed back into deficit markets through investment channels. Fragmentation disrupts that recycling mechanism. Surpluses stay closer to home. Deficits become harder to finance invisibly. Over time, this changes how exchange rates behave, even without dramatic moves. Interest rate expectations also need to be reinterpreted. Markets often focus on nominal rates and central bank signaling. But what matters in a fragmented trade system is real yield credibility. Can a country attract capital without relying on global liquidity excess? Can it fund deficits when trade flows are less elastic? These questions don't show up in daily charts. They show up in term premia and risk spreads over years. Now notice the institutional response. Pension funds, sovereign wealth funds, and insurers have extended their investment horizons while narrowing their acceptable risk domains. They prefer assets tied to domestic infrastructure, aligned jurisdictions, and essential services. This isn't fear, it's adaptation, slow, methodical adaptation. This is how institutional failure begins, when it does, not with collapse, but with misalignment. Rules designed for one system applied to another, metrics that no longer capture the underlying reality. Trade fragmentation stresses institutions built for globalization. Regulatory frameworks, fiscal compacts, and monetary coordination all assume a level of integration that is quietly eroding. Let me be clear, this is not an argument that global trade is ending. It's an argument that its character is changing. And character matters, because systems optimized for one set of conditions behave very differently under another. Investor psychology lags these shifts. Most narratives are still anchored in the last cycle. Efficiency will return. Supply chains will normalize. Costs will compress. Sometimes they do. But normalization now means something different. It means stable fragmentation, not reintegration. Look closely at policy fatigue. Governments are managing overlapping objectives: growth, security, climate, and social stability. Trade policy becomes a tool for all of them, and therefore less predictable. Businesses respond by shortening planning horizons. Capital responds by demanding higher compensation for uncertainty. Over time, that feeds back into slower growth and higher baseline inflation, even without shocks. This is where wealth and power reshaping begins. Countries with large internal markets, resource security, and policy coherence gain relative leverage. Those dependent on external demand or imported essentials face tighter constraints. This isn't moral, it's mechanical. We've seen periods like this before. After major system shifts, the distribution of gains changes. Some sectors thrive, others stagnate. The adjustment is uneven and politically sensitive. That's why it's often denied until it's unavoidable. As an investor, or even as a citizen trying to understand the world, the mistake is to look for a single trigger. There isn't one. The signal is persistence, policies that don't reverse, capital that doesn't return, trade patterns that stabilize at a new equilibrium. Slow institutional erosion doesn't announce itself. It shows up as lower effectiveness, slower response times, higher costs for the same outcomes. Fragmented trade is both a cause and a consequence of that erosion. Now let's move from structure to meaning, because by this point the evidence should feel uncomfortable rather than dramatic. What global trade fragmentation ultimately exposes is not a supply problem, but a confidence problem. Inflation in this environment is no longer just about prices rising. It's about whether the system can still coordinate expectations. When trade was integrated, inflation shocks were often temporary. Excess supply somewhere absorbed excess demand elsewhere. Today, that shock absorption mechanism is weaker, not broken. Weaker. And when coordination weakens, credibility becomes the scarce asset. Look closely at how inflation narratives have evolved. Policymakers still speak in cyclical language, transitory pressures, normalization, rebalancing. But markets increasingly price inflation as a structural variable, not runaway, not hyper, structural, embedded in the way goods are produced, transported, and secured. This is why inflation expectations have become stickier even when headline numbers fluctuate. It's not about today's data, it's about tomorrow's system. Currency trust operates on the same principle. A reserve currency doesn't collapse because people panic. It erodes when alternatives become incrementally more practical. Fragmented trade encourages bilateral settlement, regional clearing mechanisms, and localized liquidity pools. None of these replace the dominant system outright. They reduce dependence at the margin. And marginal changes, repeated over time, are how power shifts. Institutional investors understand this instinctively. That's why portfolio construction has subtly changed. It's no longer just about diversification across assets. It's diversification across regimes, exposure to different political systems, legal frameworks, and supply chains. Risk management has become geopolitical by necessity, even if it's rarely labeled that way. Now consider policy fatigue. Central banks are expected to manage inflation driven by forces outside monetary control. Governments are expected to subsidize resilience without inflating deficits. Trade policy is asked to deliver growth, security, and stability simultaneously. Over time, something gives, usually effectiveness. Institutions continue to function, but with diminishing returns. This is how slow systemic erosion feels from the inside. Not chaos, friction. More effort for less output, more intervention for smaller gains. Trust becomes conditional rather than assumed. Investor psychology adapts slowly. People anchor to past cycles because they're familiar. But familiarity is not accuracy. In a fragmented trade world, volatility doesn't always express itself through crashes. It expresses itself through persistent uncertainty. Planning horizons shorten. Capital becomes more selective. Innovation slows not because ideas disappear, but because coordination costs rise. Now step back and look at wealth distribution. Globalization concentrated gains where capital and coordination were strongest. Fragmentation redistributes those gains toward control points, resources, logistics, technology choke points, and regulatory authority. This reshaping is uneven. It creates winners and losers within countries, not just between them. That's why political pressure rises even when aggregate indicators look stable. Power follows the same logic. States that can internalize more of their economic loops gain autonomy. Those reliant on external stability face constraints. This isn't ideological, it's structural. And structures change behavior long before they change narratives. So what does this mean for long-term stability? It means the system is becoming less elastic. Shocks travel differently. Adjustments take longer. Policy errors are harder to reverse. None of this implies imminent failure. It implies narrower margins. The financial system can function for a long time under these conditions. But it becomes more sensitive to miscalculation. Coordination failures matter more. Trust matters more. Credibility matters more. The role of trade, then, is no longer just economic. It's institutional. It tests whether global rules still align with national incentives, whether markets can still price risk efficiently when politics shape supply. This is why awareness matters, not action. Awareness. Understanding that the system you're operating in is not the one described by outdated models. It's something new, still forming, still unstable. We've walked from market behavior to structure to meaning. The conclusion is not fear, it's realism. Global trade fragmentation is not a temporary disruption. It's a regime shift, one that reshapes wealth, power, and stability quietly over time. And once you see it, you start to notice it everywhere. In policy language, in capital flows, in corporate strategy, in the way risk is discussed rather than denied. Thanks for watching. Subscribe, share this, and stay alert. Because what's happening right now matters more than most people realize.